I'm Kenny Che, Head of Investor Relations. Today, our CEO, Greg Poux-Guillaume, and CFO, Maarten de Vries, will take you through our results. We'll refer to the presentation covering the most recent quarter, which you can follow on screen and download from our website at akzonobel.com. A replay of this webcast will also be made available following the event. There will be a Q&A session after the presentation. For additional information, please contact our investor relations team. Before we start, a reminder of our forward-looking statements disclaimer on slide 2. Please note this also applies to the conference call and answers to your questions. I will now hand over to Greg, who will start on slide 3 of the presentation.
Thanks, Kenny, and good morning, everyone. Our Q2 results were in line with expectations, and I'm pleased to report solid year-on-year growth in both profit and return on sales. Q2 volumes were resilient, down only 1% versus Q2 2022. Europe, in particular, showed signs of having bottomed out. Revenue was up 3% in constant currencies. Pricing was up 5%, with coatings resisting better than anticipated, helping us to achieve the top end of our pricing guidance of 4 to 5%. Raw material deflation also finally started at group level during the quarter. While pricing and raw material deflation resulted in margin expansion of 149 million euros in the quarter, our profit continued to be partially held back by adverse currency effects and operating cost inflation. Adjusted operating income was up 25% to 311 million euros or 325 million euros, excluding the accounting impact of hyperinflation. Overall, we had a solid first half of the year. Half-year revenue grew by 5% in constant currencies. Pricing versus raws of 209 million euros in the first half means that we are well on track to deliver near the upper end of the full-year guidance range of 250 to 450 million euros. The resilient pricing and better-than-expected volumes achieved during the first half resulted in an adjusted EBITDA of 702 million euros, and this despite 38 million euros of negative Forex impact. We are therefore increasing our full-year EBITDA guidance, as we will see later. Finally, our leverage came down from 4.2 times in Q1 to 4 times, and we are on our way to deliver on our target to achieve a ratio of below 3.4 times, including the Kansai acquisition cash out at the end of the year. Moving to slide 4. This quarter, we continue to demonstrate our technological leadership in performance coatings. We're continuing to drive innovation in packaging with the launch of an internal coating for beverage can tops that does not use BPA or bisphenol-based epoxies as part of its manufacturing process. This product completes Akzo Nobel's full can offering and will help our customers to meet the surge in demand for safer and more sustainable coatings, supporting our leading market position. And importantly, our new product integrates easily into customers' existing manufacturing processes without disruption. And our marine business continues to capitalize on the sustainability leadership to gain momentum. We secured supply to several new-built LNG carriers in Asia, which will utilize our high-performance Intersleek systems. Intersleek is a biocide-free, foul-release solution which delivers fuel and emission savings for owners and operators and helps to support the industry's decarbonization ambitions. Our best-in-class technology continues to support significant wins and share gains. Turning to slide 5, we'd like to provide an update on how we see volumes progressing across our businesses at the half-year mark. After a better-than-expected first half in paints EMEA with volume stabilizing, especially in the DIY segment in West Europe, we now see further improvements to our full-year volume projections. Volumes for the year are now forecasted to be down low single-digit % as we lap easier year-on-year comps in the second half of the year. While demands in China were mixed and softer than anticipated in the first half, we retain our expectations of double-digit growth for the full year on the back of depressed volumes during the second half of 2022. Volume trends for our paints South Asia were mixed in the first half, as growth in India was partially offset by market weakness in Vietnam. Volume trends in Latin America were also mixed, with underlying demand stronger in Brazil and challenging in Argentina because of its economic context. we now expect the combination of these two markets to be up low single digit for the full year. Within coatings, first half trends in both industrial and powder coatings are largely expected to continue in the second half. While construction-related segments remain soft, there are bright spots in powder, and coil continues to perform better than anticipated. As such, we're heading towards the better end of our previous full-year range of down mid to high single digits for these combined businesses. Through a strong first half for marine and protective, a dynamic market currently, we see upside to our previous projections. Despite tougher comps in the second half of the year, we now expect combined volumes for our marine and protective and automotive and specialty businesses to be up mid-single digit, increased from low single-digit growth in the previous guidance. In summary, despite continuing macroeconomic uncertainties, the stabilization of volumes in the first half gives us confidence to update our forecast for volumes at group level to be more or less flat for the year. I now hand over to Martin to go through the numbers on slide 6.
Thanks, Greg, and good morning to everybody on the call. In the second quarter, our reported revenue was down 4% versus the prior year and up 3% currencies. Volumes were 1% lower and better than anticipated as market demand in Europe stabilized. Pricing continued to hold up well at 5%, and M&A added 1% to revenue growth, with partial contribution from Grupo Orbis, which closed in late April the prior year. FX reduced revenue by 7%. This is a much larger impact than what we have seen in previous quarters and was mainly driven by weakening currencies in Turkey, Argentina, and China. Hyperinflation accounting reduced revenue by 2%. Adjusted operating income, including the adverse impact from hyperinflation accounting, was 311 million euro, up 25% year-on-year. Excluding hyperinflation accounting, adjusted operating income would have been 325 million euro. Return on sales increased by 260 bips to 11.3%. Revenue in decorative paints was up 5% in constant currencies, mainly due to higher pricing, which was up 6% in the quarter. And revenue in performance coatings was up 2% in constant currencies, mainly due to higher pricings. Volumes were 1% lower, with growth in marine and protective offset by continued soft demand in industrial coatings. Pricing in coatings continued to hold up better than anticipated, up 4% in the quarter. I'm pleased to report that both paints and coatings achieved solid year-on-year growth in adjusted operating income in the quarter, driven by better than expected volume developments and resilient pricing. Over to the profit bridge. Adjusted operating income in the second quarter was 311 million euro, an increase of 62 million euro from the prior year, mainly as a result of pricing, which delivered a benefit of 144 million euro. The volume impact of 70 million euro reflects a 1% fall in volumes and indicates a stabilization of trends seen versus previous quarters. The effect of mix was primarily related to our paints businesses, including geographic mix impact in China. As Greg mentioned earlier, we saw the first benefits of raw material deflation in our P&L at positive 5 million for the quarter. Combined with pricing, the overall margin expansion in the quarter was 149 million euro. Operating expense and other one-offs reduced adjusted operating income by 90 million euro. As anticipated, underlying OPEX was higher year-on-year, with costs rising due to inflation, along with our response to better than expected volumes. While our savings programs are executing as planned, we now expect higher OPEX year-on-year in the second half, given higher inflation and improved volume projections. The impact of depreciation in currencies, namely the Turkish lira, Argentinian peso, and Chinese renminbi, reduced our adjusted operating income by 27 million euro. The negative impact from hyperinflation accounting came in at 11 million euro. Moving now to slide 8. The second quarter marked a pivotal point as we realized the first benefits of raw material cost deflation in our P&L. We captured 5 million of deflation in the quarter, a small but promising number. We believe we have finally turned the corner on this important metric. Our pricing of 5% in the second quarter was at the top end of the guidance range provided in the previous quarter. This represents cumulative pricing of 25.5% over the 3-year period. Moving now to slide 9. Our adjusted EBITDA for the second quarter came in at 397 million euro, an improvement of 18% versus prior year. In the first half of the year, adjusted EBITDA was up 7%, reaching 702 million euro. In the second quarter, we started realizing improvements in our working capital position. We reduced inventory by 82 million euro and raised payables by 140 million euro sequentially. Overall, our working capital as a percentage of revenue decreased from 18.6% in the first quarter to 17.5% in the second quarter. Higher EBITDA and the release of working capital supported our free cash flow that turned positive and totaled 249 million euro in the second quarter. As expected, our leverage improved to 4 times EBITDA from the peak of 4.2 times in the first quarter. This is a result of EBITDA growth and gradual working capital unwind that were partly offset by our final dividend of 268 million euro paid in the second quarter. We remain on track to achieving a leverage ratio of below 3.4 times, including acquisitions, by the end of 2023. Now back to Greg.
Thanks, Martin. Overall, we had a solid first half of the year, mainly driven by stabilizing volumes, robust pricing, and the first effects of lower raw material costs. This provides a solid foundation and sufficient clarity for us to update our full-year guidance, despite a macroeconomic environment that remains unclear. We now expect to deliver adjusted EBITDA of 1.4 to 1.55 billion euros, towards the top of our previous guidance range. As previously explained, this reflects our updated guidance of flattish volumes for the year and margin expansion towards the top end of our previous guidance of 250 to 450 million euros. Our leverage ratio guidance of less than 3.4 times by year-end remains unchanged. And we're executing well on our priorities. We look forward to updating investors on the progress and objectives of our industrial transformation with our Q3 results. I now hand over to Kenny for information about upcoming events and the Q&A session. Kenny?
Thank you, Greg. Before we move to the Q&A session, I would like to highlight the date of our third quarter results, which will be on October 25th.